This is my financial disclaimer so I don't get sued.
Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. Let's take a look at what we're covering in today's video. In tonight's video, we're going to be going over the data sets. Usually I'd be covering the earnings, however this week there is no earnings at all to speak of. And I will be going over the technical analysis for the SPY for week of December 29th, 2025. And thank you all for watching, I appreciate it. And with that said, let's go ahead and jump straight into the data. Now, this week is a slower week. We don't have a ton of data as the market is closed on Thursday due to the new year. However, on Monday at 10 a.m., we have the pending home sales. I don't really have anything to say about that right now. They're expecting a decrease. I am kind of in the same boat with that. We've been seeing consumers with the housing sector really starting to struggle. So we've been talking about this for about 2 months now, that we've been seeing weakness within the housing market, and now we're starting to see that the pending and new home sales have been really slow or dropping off. So it's interesting to see these data sets. Not that they will move the market too much currently, but they are important in the grand scheme of everything. Now for Tuesday at 9 a.m. we have the housing indexes. Um, they're expecting a slight decrease in the year over year. The month over month, they're not showing the forecast. These don't move the market too much, but they are something to obviously keep in mind, especially with all the housing data coming out this week. At 2 p.m., we have the FOMC meeting minutes. Now, that will be pretty interesting because, again, there were dissenters in the last meeting minutes, and it'll also highlight that one of the dissenters were actually extremely dovish going into 2026. One of the dissenters that I'm talking about basically is expecting to cut many times in 2026, and the only reason why he did or voted for a pause in December was specifically due to that. He wanted to keep things neutral until the new year and basically just start cutting like crazy. Um, so really there was only one of the dissenters that wanted a neutral rate out of hawkishness. The other dissenter wanted a 50% or a 50 basis point cut. So when all these news articles are saying there were three dissenters, it's really misleading. Only one of them were dissenting in a hawkish way. The rest of them were extremely dovish. So it will be interesting to read those FOMC meeting minutes. However, I don't really expect to learn anything new, but perhaps maybe the market might open their eyes a little bit. We'll see. Now, on Wednesday, it will be a full trading session, even though Thursday will be closed. It won't be a shorter trading day or anything. Same with Friday, so keep that in mind that Wednesday and Friday will be full sessions. Now, for Wednesday at 8:30, we have the continuing initial jobless claims. I kind of put that into one word instead of saying and, but we're gonna roll with it. Um, we did see an uptick in both pretty much last week. Now, the continuing jobless claims, they saw a very slight decrease. Um, However, in the grand scheme of things, we saw a major increase in the jobless claims the last two times in the initial jobless claims. So it's definitely pointing to that there will be a continuation in the continuing jobless claims. So then at 9:45 we had the Chicago PMI. They're expecting that to be higher. I really disagree with that. I kind of, call me bearish, call me hawkish, whatever, but I don't really see the market and everybody, or I don't say mean the market, but the economy. I don't really see the economy wanting to push things up higher and higher right now. A lot of these data sets have been coming in quite cool over the last, couple months now that we've been getting data again, except for that GDP print. But As you've watched my videos last week, you know my opinion on that. Now, again, Thursday will be closed. Friday will be a full session, so 9:45 a.m. We have the manufacturing PMI. Now, we had the non-manufacturing PMI last week. I thought they were going to have both the non-manufacturing and manufacturing within the same week as they usually do, but due to, the holiday last week, we obviously could not fit both of those data sets into the week. So they moved that one over to this week. So really, this is kind of a continuation of last week's data in terms of that global manufacturing PMI. Really, that goes hand in hand with the non-manufacturing PMI, and those were cooler prints, if I remember correctly. At 10 a.m., we have the construction spending month over month. They're expecting a very cool forecast again, with a negative. I definitely agree with that. From everything I've been reading, all the data sets and whatnot we've been going over, we have been seeing that, construction spending and housing has been, or just construction jobs all around, has been massively falling off. We've been seeing many of these construction leaders having to start discounting a lot of their projects that they already have built and have already started to cancel some of their future projects and having to, rewrite the terms and everything of it due to the prices and whatnot of everything. And so I'm definitely expecting the construction spending to continue to show us negative numbers or very cool numbers, probably for the next few months, unless we see, some massive surges in, some massive surge in hiring and new construction jobs and all sorts of stuff. But currently, the labor market's really showing us a lot of weakness. Going back to that continuing jobless claims, currently, it's closer to the 1.9 million. It was starting to pull up to that 2 million mark, and it dropped back down. It even at one point dropped to the 1.8 something million. Not last week, but the week prior. And many of us disagreed with that number. And, of course, the week after that, it shoots back up. So I definitely think that we will be seeing this pull up towards the 2 million mark. Now, unless we see not so much the jobless claims, but the new hires starting to increase and the wages starting to increase, then really we're not getting out of this slump of a slowing down economy. Um, I really just want to kind of hammer that point in right now is that all the trends show us a downtrend. If you look over the last year, of open hires, of new hires, of the wages, just everything job related. And you can go from the national data to state data, and majority of the states and everything are going to show that there has been a downtrend in all of those numbers. Um, that's not good. That's not what you want to see. I know that the market is at all-time high. Uh, Obviously, that's going to be a large part due to AI spending. AI spending is really a closed market. I've been doing a lot of research into it over the weekend. Um, we'll talk about it in another video, but yeah, there's a lot of spending into AI that really just gets locked directly into AI and semiconductors that won't ever really exit. There is a pretty massive business model set up for it right now, but it's not a business model that includes, real consumers. It includes the top echelon of these data companies and AI companies. So, um, I have my qualms about it, but that's for another video. Anyway, we're going to skip the earnings because obviously there is no earnings this week.
If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime.
And getting into the technical analysis, as always, let's make sure we have our daily time frame turned on and our moving averages and Bollinger Bands. Now, last week on Friday, we did not get the upper Bollinger move again. Um, this is once again kind of a worrying sign, as I've talked about in many of my videos how there's this room between the 5 mile where the market price is above that range, but below the 5 mile range, and not choosing to really claim either of those ranges. Both of those ranges start closing off, and eventually either it's going to have a massive push to the upside to claim that upper Bollinger, or there's going to be a massive, massive push to the downside. And some of those ranges gave us, some of the biggest selling numbers we've seen. That's what happened right before we had this massive sell-off. No, I don't think there's a massive sell-off coming right now. I'm just talking from past experience that when we started seeing those upper Bollinger rejections continuously happening, and we were seeing the market price stay above the 5 mile but not, really want to test the level, it was taking right to the bottom range of the upper Bollinger, but never really crossing it or making that upper Bollinger move. It completely just dumped. So, no, I'm not saying that's going to happen. Here's another example where that didn't occur. We had the upper Bollinger move happen very, very successfully, and then that started to create a major sell. Now, another example of this, I apologize, but another example of this where we had some major rejection of that upper Bollinger range, and then we started to have a massive sell. Another example is right in here where we really didn't get those upper Bollinger moves. We stayed above the 5 mile, stayed below the upper Bollinger, and then we rejected. So it doesn't always happen. However, it tends to be one of the things that can happen. So just be aware of that. If we see, sorry, I just kicked something by mistake. If we see extremely bearish data or extremely bearish news. I know there isn't a whole lot of data this week, so if there's bearish press releases of some sort, something posted on Twitter by somebody, I don't know, I don't really care. If there's something bearish that's enough to cause the market to sell off, then that's probably the only reason we're really going to see a major sell at this point. Um, Another thing to kind of highlight why I don't think we'll see another sell at this point unless we get some pretty bad news is because we have been testing the 20 mile very, very often over the last 2 months. Almost 3 months now. We've been having quite a lot of price action where we actually see the price move very well below the 20 mile. Now, during this whole rally since April, we didn't really see any move below the 20 mile except for, I want to say it was a whole 2 hours tops. There was about 30 minutes within this range, and then about an hour and a half over here. Um, but that was months and months and months of really no 20 mod test, and that was a big reason why I got really, really exposed on the short end because I was expecting a deeper test of the price action and everything with the lower Bollinger and whatnot, but that didn't occur. Um, with that said, we have been trading within the 20 mile range. Um, this is standard price action. This is how the market should be trading. This is seeing plenty of upside, downside, upside, plenty of moving average tests. This looks very, very good. What we had in here was very sketchy. Um, in hindsight, it might look like, oh, super easy to just play the upside. It didn't look that way because again, once we get to the upper Bollinger, that's when we start to short. And a lot of these upper Bollinger moves were not only just upper Bollinger moves, but they extended the move. As you can see in here, they did the 5 mile test and literally just jumped right back up to the upper Bollinger. So all of us who started shorting at that range got cooked. Um, then they consolidated, pulled up, we shorted there, had a really good run. Not all of us sold at that 619, 618 range, whatever it got down to. But a lot of us made some good money there. Then it pulled back up, pulled down a little bit, pulled back up to the upper Bollinger. This move cooked people again a little bit because it extended, had the move down to the 10 mile, and then it was directly back up to the upper Bollinger. That one was a little tricky, but if you had your positions out for the 3 weeks, as you know, stated by the rules of the upper Bollinger move, you would have caught that perfectly. Um, the reason why I'm bringing that up is because we've been seeing a lot of really standard price action in terms of both the upside of the 20 mile and the low side of the 20 mile. We've been testing the 20 mile quite heavily the last, 2 to 3 months. Is there a reason for us to go ahead and test the 20 mile again? From a liquidity standpoint, no. We have all the liquidity we need right now to continue pushing upward. Um, I heavily expect us to have the upper Bollinger move. And if we don't, we need to be looking very closely at that 5 mile move. Um, 5 mile should be around, I think I mentioned the 688.50 range, and it could be a little higher, could be a little lower. Just make sure you mark it down on open. That range is going to be very key because if the 5 mile is rejected to the downside, then that's how you get these massive sell-offs. Okay. However, if we see a bounce off of that 5 mile to the upside, then with the upper Bollinger being so close to us right now, that really only gives you one way out of this, and that's to the upper Bollinger. So I do really expect that move to be taken. If not, then again, we're looking at the 5 mile. If there's a rejection on the 5 mile, then we look at the 10 mile and the 20 mile. Now, the 10 mile and 20 mile are almost right on top of each other currently. The 10 mile will start pulling above the 20 mile just slightly. As of Monday's open, it won't be at the 682, I don't think, but it might be. The 20 mile is also going to be pulling up slightly as well. So for at least 2 to 3 sessions, we're going to see the 10 mile and the 20 mile very consolidated on top of each other. That could be a good or a bad thing. And we mentioned this kind of back in here during the beginning of November when we see the moving averages really consolidate. Um, the 10 mile and the 20 mile, that's when the 5 mile can really pull down and kind of collapse the moving averages. And that's something to be aware of is that if we do have that sell down here, the 5 mile is going to pull below not just the 10 mile, but the 20 mile. And once the 5 mile is below the 10 mile and 20 mile, with the price below the 10 mile and the 20 mile, that means that the 10 mile and 20 mile will no longer be trying to move upward. They'll start pulling down towards that 50 mile. Now, we did not have the 20 mile pull below the 50 mile this last time. We talked about how the potential was very high, but it didn't do that. That's kind of the next major bear signal we're looking for. Besides the initial being the 5 mile across the 10 mile and the 10 mile across the 20 mile, is that we really are looking for the 20 mile to cross the 50 mile if we're looking for a major downside. Um, Again, if we do have the upper Bollinger move, upper Bollinger day 1, we want to close at or above the upper Bollinger. Day 2, we expect a higher high, and from that higher high, we will expect to consolidate down into the 5 mile, which is generally happening on day 3 or day 4 of that move. So I do see the upside here. We have plenty of bullish structure. Let me go ahead and turn off the Bollinger's averages for a moment here. We have this completed cup. Essentially, we're working on a handle in here. Sorry, the drawings decide to mess up when I open it on my phone compared to the computer. But potentially this is trying to create a little handle within here, maybe do a 5 mol test and then see the upside. Um, Going into this week as well, it would be very weird to see massive selling occurring prior to the first, because you wouldn't be tax exempt on those if that was the case. You'd have to, file for taxes on those for those this year. So I don't really see a lot of firms trying to dump all of their shares the last few days of the year. It can happen. Now, potentially we still have the whole yen carry trade uh, ordeal going on. I'll talk about that in a video with TLT, which I'm actually going to make right after this one. So I am going to go ahead and end this video here. Thank you all for watching, and I will talk to you in tomorrow's video.